Yeah, I run N2 Communications. We are a creative agency. We tend to focus on a lot of B2B content, and also B to LP, but investor content is a lot of what we do. So we work for asset managers of various stripes, hedge funds, venture capital firms, private equity firms, handling a lot of the pitch decks and the quarterly and annual reports and newsletters and podcasts and things like that. But also a lot of venture backed tech companies and but also a lot of a pretty broad range. We have a great big talent pool, but those are our core businesses. Is um, things that skew a little more technical and expert, the sort of technical founder of venture capital firms and things like that. And yeah, places, but that need a broader storytelling sort of need, because the audience is sophisticated but not necessarily expert in all these fields. Yeah. Well, I was a reporter. I mean, starting when I was like in high school, I was still, had some stories out there published, and then through college, working at the college newspaper, and then had worked as a freelance journalist, had been a and reporter. Journalist can mean a lot of things, but wasn't an opinion person, not on the sort of talking head side, anything like that, but hard reporting. Facts, figures, where, what, when, doing sometimes police reporting, investigative work, and a lot of financial work. Working for like Chief Investment Officer magazine was one place, but doing a lot of sort of wonky finance, things like that. And I guess I kind of saw the writing on the wall with what was happening in journalism and publishing. I published a book with Riverhead Books, Penguin, and was freelancing and sort of saw a little bit what was happening with the way that journalism was going into a more clickbaity, less sort of substantive, nuanced world, and more of a sort of us versus them, good guys, bad guys, kind of where it just wasn't really the kinds of things I was interested in. And so I really kind of diversified the portfolio, if you will, working for data science companies and hedge funds and places like that, where I could help them with, their annual reports or with, white papers they were producing, ebooks, podcasts, things like that, telling those stories. And I found and the journalism is a extremely competitive and not very lucrative field, and found that I could, balance that corporate work, which paid a little better, with some of the editorial. Although at a certain point, we got large enough that I wasn't really able for a number of years to really do any reporting. It's kind of my running joke. I had this dream of a half-time corporate, half-time editorial reporting life, and was too busy creating that for other people who work for me to actually have the reporting time for myself. But the money made up for it. But over the years, I've been able to do more reporting. I'm doing, actually, it's good timing. We're doing this podcast. I'm doing a sort of a video podcast audio book of my old book, which is about the history of data automation and about how New York City sort of burned down and went bankrupt in the 70s. But there's so I cover a lot of different areas, but it was usually along these lines of systemization, data automation, and sort of what happens when you have these computer data driven ideas, and what happens when the rubber hits the road, when sort of real life hits and the complications of an actual business happens. And that's sort of an area I've always been fascinated in, and it's been great to cover that as a reporter, but also to work in it firsthand. It's one thing to criticize from the outside as a reporter. It's another to actually try to build something, and sort of grow and things like that. And so it was great to be able to sort of see those challenges on both sides. And so, yeah, started the company, and we sort of vary how we're structured. Sometimes we work as like sort of a headhunter. We go out and find a writer, a researcher, or whatever it is. Other times we're almost kind of like a talent agency. We're kind of structured like that. Other times we're sort of kind of a full outsource provider where we handle a lot of the work. You know, and that's usually, I think one thing that there's been this interesting shift where there were companies, and then there was the media. and you had sort of PR people, communications people who sort of sat in the middle, and their job was to kind of turn on the media machine on behalf of a company that had an interesting story to tell. And really, what we've seen over the last 20 years is on the journalism side, the industry has not entirely, but largely collapsed. I want to say there's like 80% of newspapers are gone now from where they were 20, 30 years ago, driven largely by social media and these other platforms. Now, what that's meant though is that places besides, the old gatekeeper media have access to these platforms and to audiences, eyeballs. And so, companies had to start figuring out how to tell their own stories in this new way through their own channels and things like that. And so I realized that, the skill sets of a journalist are really well suited to that, to helping companies figure this out, because it is, the journalism industry has a monetization problem. But the core skill sets, I think are intact. And I think the core models of being able to, it's really difficult to publish a daily newspaper. It's really difficult to publish a weekly or even monthly magazine, things like that. And so there are people who just have a lot of expertise. It's not something best done by, some junior staffer who was once a journalism major or something, is not the way to do it. It's a real skill set. And the folks are available. I think they're the best value in the knowledge economy. It's people who can deal with writing reports and interviewing people and good judgment, self-motivated, keeping on time, working in multiple mediums. And so those skills are incredibly valuable. And so kind of sitting in the middle and helping set things up, because I think, certainly some places want to hire those jobs full time, but it's difficult. We have engineers that work for us. I have other people hire them because I don't know how to judge an engineer. I can't write code. I think it's very difficult too for an investment professional to understand the ins and outs of storytelling to different audiences. Some are intuitively great, but I think that being able to set that up, and for the storytellers themselves, I don't know that anyone grew up obsessed with movies and books and wanting to tell stories who dreamed of being a forward networking solutions technical writer for a cloud provider or something like that. It's not the dream job. It's good work. It's interesting, but people still want to be able to work on the literary magazine or write poetry or be work on Broadway, whatever it is. Exactly. And so for a company, that means that if you can hire, sort of a part-time contractor, they get the best of both worlds. They get to have that creative output, and the social capital that comes with that, while having a good, steady corporate job. And, when we started, I thought that having a lot of contractors, we would lose people. We'd have a lot of turnover. It's actually quite the opposite. We don't really lose. It's very rare because people, when they can have a good, steady gig that's interesting with a good client that pays a lot of the bills, and it leaves them free to write their books and produce their plays or whatever it is, they love that security and they're very happy to be there. They don't need a lot of promotions and raises. They're fine with a glass ceiling. They're there to do their work, do an excellent job, and then go back to their creative work. And that's a really nice blending that creates a lot of stability for companies and can really tap into expertise from, the best people in these very competitive fields. Yeah, right. Yeah, exactly. So the started with just me, and then very quickly a partner. It was actually the co-founder of a data science company I worked for, and so we had a podcast. We were consulting. We were doing all these things, and then just started picking up more and more clients. We're fortunate enough to pick up a couple of great, large, stable clients where you can have your base of business. And initially all that systemization was really focused on providing excellent services for those clients. It's people often think, I think, especially from the outside of creative fields, as being you sort of like you're struck by a lightning bolt from on high by the muse and things like that. But I think it's a lot closer to the Thomas Edison line about It's 99% perspiration and 1% inspiration. A lot of it is it's hard work and structures. I talked about, you think about a daily, newspaper. Um, there's, and even a magazine, you think about, I call it the masthead, right? That's the list of all the people that are working there. There's a editor in chief, and then there's a writer whose, byline is on the piece. But there are all these other people who are in charge of all these other functions. And those are deeply systematized, kind of operations. They're kind of factory like, a story moves from the idea generation to research to pitches, refining, editing, visuals, layout, publication, all of that, and you really do want it to move like a conveyor belt, with really clear roles and responsibilities, clear lines of communication, and it runs really well. For folks who haven't been in those systems before, oftentimes it's a little. There's an old I Love Lucy episode where she's working, I think, at like a chocolate factory, and something goes wrong on the conveyor belt, and then suddenly Lucy is just, instead of moving the chocolates from like the belt to the box, she's just cramming them in her mouth because she doesn't know what to do. And without a really good, really defined system, that's the way, sort of the editorial process can look. There's all these systems and conveyor belts, and then suddenly all the stuff just pours into a pile on the floor where some indeterminate number of people with indeterminate responsibilities are running around with their hair on fire trying to figure it out. And so that's our process, is to like turn that, to systemize those kind of lumpy, chunky, sort of inefficient parts. Yeah. Yeah, that's just it. That sort of portrayal, I think it's not quite as unrealistic as all these newspapers and magazines and movies, which have these like gorgeous offices with, like all these things. Like the average newspaper has, a couple of extra paper clips lying around, a lot of drop ceilings, a lot of, not well heated or air conditioned because budgets are so thin. And yeah, I mean, now, to be fair, I think creatives in general and a lot of journalists, who's, many of whom grew up with a sort of motto of like speaking truth to power. There is a roguish, renegade, romantic side to that from a lot of people. So there's always that tension. But any publication, yeah, it is filled with people whose job it is to run tight machines, and if they don't do that, the newspaper doesn't go out, the ads don't get printed, and the bills don't get paid, and all of these things don't happen. They have to be really tight machines. And as the journalism industry has sort of has crumbled a bit, not that every place is perfect, but I found that the systems they used for putting the stories out were by and large quite efficient. Their ability to, when the want ads went away, when all these things happened, with the internet and social media, it crumbled. But a lot of the other core business systems were quite good and could be translated into corporate environments quite well. So like trying to take that piece of it and bring it to the table. And then internally with my own folks, the creative mentality can be a little cantankerous and rebellious and things like that, as it should be. What's nice is that most of my folks, they still have a byline, as they say. They have work that they do on their own where they can be the control freak, egomaniac, and do all that. When it comes to client work, I always tell people, like, check your ego at the door. Give your advice. You have a lot of experience. But if a client wants to do something different, that's their choice. This is their story, this is their process. They're the ones paying the bills. Like, give your advice, but if they want to do something different, that's fine. It's not an attack on you. You don't need to, like, this is just the way they'd like to do it. And people are, I think, are able to sort of separate quite well in that regard, and say, okay, well, I've got a book of poetry that's coming out in a year. That's got my name. I will, like obsess over every comma and word and all that. For the client, it's their piece. We do the best we can to help them tell their story, but it's their story. Well, one of the nice things about being in a client services business is that to some extent the goals are outsourced. It is all about the client. That they're happy with the story that's being told, and I work really hard to develop KPIs and metrics and things that really measure success so we know when we're doing a good job. And so we try to meet those goals. And sometimes those are tough to quantify. Other times they're not. Is the newsletter subscription growth working? Did the pitch deck for this, that early stage company is putting out there to do their Series A, were they fully subscribed? Did they get the investors? Was the story that we helped them tell compelling enough to investors? And so we try to, really focus on that. Internally, it's pretty straightforward. And, there's sort of, because they're there's in the talent agency world and places like that, there are these models. Our company, I don't really know of other companies that function quite like us, but you can borrow these things and you get an understanding of like, okay, what are reasonable profit margins so that you can run a profitable business, but that you're not kind of taking too much from your clients. Because I want clients for the long term. I think that the early stages of business development, sort of cold contacting and all that sort of stuff, and like sort of advertising, that's it's a process that's fine, but it's not one I love. I love getting in when I can identify like what does the client need, what is the budget, how do we structure it. That's the part that I really love, and so I take that and then the work itself, and so trying to do as systematic approach to that as possible is really the focus. And then the business development, we should perhaps be a little more systematized, analytically driven. But what we found is that if you're like laser focused on client satisfaction, you get referrals. We get referred to other companies. Venture capital firms refer us to their portfolio companies. Portfolio companies refer us to their venture capital firms. People leave one firm and they go to another one and they hire us there as well because we did a good job the first time. So, I think that we've had really stable, steady, organic business growth in that way where we don't lose many clients. They tend to grow the account, as they do well, and that gets bigger, and then they refer us out. And so that has provided enough good, steady growth for us. So that's really where we focus on that on the client side. Is really where yeah, that's what I'm saying. Yeah, well, one of the big advantages of having spent years as a financial reporter and then of, working for a lot of different investment firms is that I got to learn a lot. I joke that yeah, it's like getting a master's from the London School of Economics, but getting paid to do it to some extent because you're deep, deep in those the minds of those traders and people like that and understanding. So basic portfolio balancing and things like that you learn a lot about, and that was sort of the start of it, getting a good diversified portfolio There's gold and stocks and bonds and geographical diversification and industry diversification. Another thing I try to think about is that, my the bulk of my income is coming from, when growth is good, generally speaking, my clients are doing quite well. Markets are up, they're making money for their clients. Tech companies are getting funded, they're growing, they need content. And so I try not to have a personal portfolio that has the same risks. That's like that as a good example. I try to think about, so if I'm, a lot of our clients are involved in, in the financial world. I try to think about, like, well, what happens if their risks come to fruition? And so I tend to have a pretty conservative portfolio. There's an old Jerry Seinfeld joke about, some TV commercial, about, like, let your money work for you. Jerry Seinfeld says, I'll work for my money. Thank you very much. My money should stay at home, safe and sound. I'll go out into the world and earn more. The money should, I want the money safe. I think to some extent, I'm probably more risk averse than I probably should be. Perhaps. Yeah, there's certainly, certainly, I think that could be the case, but, I think that's okay because of that diversification and balance. And, when times are going great, you think, ooh, I should have taken a little riskier approach. And then, of course, when things go wrong, you think, ooh, maybe I shouldn't have had that risky approach. So, it's all a balance. But yeah, I try to be systematic. I mean, I have a fantastic, guy, my man Sam Canary with Morgan Stanley, who's a very helpful advisor, very savvy wealth advisor. I try to have, conversations with him and figure out when to rebalance the portfolio, when one thing's up and one thing's down. But I try to stay out of it. I think that, like, you should take risks on things you understand the best. I understand a little bit about finance, but I'd prey to so many variables that are beyond my control and my understanding at times, that I want to have. I don't want to get sort of too big for my britches and make decisions that are, and risks that I don't really understand. Whereas on something like writing or storytelling, I take a lot of risks, because I feel good about that. If I feel the conviction of that story, I'm open to all kinds of different ways of telling it and framing it and all that, because, like, that's a field I really know. And so to some extent, I like to defer to the professionals and defer to fairly timeless, I think, sort of, balance structures, that are gonna do well in different environments. Right. No, but well, I think actually in a lot of ways, investing is not that dissimilar from reporting. You're trying to take a lot of different sources of data, whether that's, literal numbers in a spreadsheet type data, or if that is, like, information about various markets, the people involved, things like that. You're trying to get at some sense of truth of what's really driving the economy, what's driving a business or an industry, and things like that. And you put that together in a coherent way, and then you figure out how to invest based on that. And I think so. I think that that's ultimately that's the job of reporting, and that's the job of a good investment manager is internally, or if they're publishing externally, or they're sending out things to their LPs, of trying to get at some sense of truth of what's happening in the world, or at least the best guess you could make about what's going on in the world, and then act accordingly. And so I think that's in that way they're not that different. And so I think a lot of the same approaches apply of having rigorous research. Um, of understanding who are trusted individuals. There are some sources that are extremely trustworthy. Other sources might be a little less trustworthy and need a lot more verification before you're going to act on that information. And I think it's quite similar. You want to approach that similarly in that sort of rigorous, analytic, and also he says machine-like way. You want to leave some room for common sense, but the data is generally going to be more accurate and more consistent than your gut instincts are, especially if you're paying attention to cable news or the financial news or something like that. It's easy to get the animal spirits are a real thing, herd mentalities are a real thing. I have a friend. Yeah. Oh no, I was gonna say, like, in like the gambling world, they talk about, like, in football, American football gambling, they talk about public teams. And a public team means a team that has lots and lots of fans, probably in wealthy areas, who are gonna bet for their team. And so those teams are often mispriced. They have that you actually want to bet against them because there's too much money for going in there for personal psychological fan reasons. So you're going to do, if you consistently bet against that. And so, in other words, you don't even necessarily need to understand the sport so much as you understand reflexivity, right, would be one of the investing terms for it. The way that the pendulum swings back and forth, and the way that it usually swings too hard in one direction or the other. So if everyone's talking about something as this is the hottest new thing, it might mean it's the hottest new thing. It might mean people are a little too excited. So you want to think about how to hedge that bet a little bit, and how to de-risk it. And that's the way I tend to think, and really uncovering. The other one is, of course, uncovering all your sources of risk. I was interviewing chief investment officer once many years ago, and he was talking about a stock bond portfolio, and he was saying the trouble is there's a lot of different kinds of stocks and bonds, particularly bonds. If your bond portfolio is mostly high yield corporate debt, well, that's the same exposure as stocks. You same kind of risk. If you're gonna you get there in a bankruptcy, you're a debt holder, a bond holder can claw something back. As in a bankruptcy filing, an investor gets wiped out. But other than that, it's the same risks, the same companies, and things like that. So is that truly a diverse portfolio? If your bonds are all corporate, and of course all stocks are corporate, then that's a different. Those risks are kind of together. Where you might get much better diversification if you could be in all stocks, and no bonds, but if you spread out those stocks to different industries, different geographies, different kinds of growth companies, value companies, you could actually get more diversification from just one instrument than from multiple instruments if those multiple instruments all have the same risk profile. And so, like, really kind of exactly right. Yeah. Yeah, no, that's exactly right. And we've seen so many different, and it's unfortunate on the whole, but like during my career, I was working, covering sort of finance and data and things like that when 2008 happened, and learned a lot from that. Have seen, I wrote a very, very early story on cryptocurrencies. I've seen those go ups and downs, and mostly ups, but with a lot of dips along the way. We've seen all these new, the way the fintech world, the sort of decentralized finance, all these things that have happened over time that are in the last 10, 20 years that are fascinating, complicated. Um, it's really interesting to see and try to learn from. but I'm also sort of historically minded. I wrote a book. It's a history, you know. So I do tend to think about like what are the longer term trends that to try to understand. I remember in 2008, you know, there were all of these, you know, as the sort of mortgage bond market was starting to collapse, and you know, you had all these sort of banks and places that were saying like, oh no, the value at risk models show that you know there's no serious risk of more than a 5% or whatever drop. Um, well, and then you come to find out later, the value at risk models are based on they only have like 10 or 20 years of mortgage data. That's a tiny sample size. That's we have a much longer history, and then you know other firms that have like, oh yeah, we've got all the mortgage data we can find from as long as there were mortgages. They knew that there are times when the entire American housing market goes down. It happened in the 1930s. If your data set's small, you didn't know that. And so like making sure to think about those kinds of risks, what's baked into your models that you don't understand, the sort of you know the known knowns, the unknown unknowns, the known unknowns, all that sort of stuff, and really try to think about there's also one, and specifically on as just a quick aside, there's a four quadrant chart I've seen that's I love that is it has you know the different economic conditions, basically where you have like you know, it's rising growth, you know, shrinking growth, rising inflation, or you know, flat or shrinking inflation, and sort of thinking about those environments and like kind of allocating as such. What's going to do well when everything's up? You know, inflation and growth are both up. When inflation's down and growth is up. When both, you know, like these different scenarios, and trying to think of like, okay, these are the four basic economic scenarios. Do I have something that can capture value in each of those? And do I have things that can mitigate risk during those things? And really, that those kinds of balances are, you know, that sort of systematic balancing. I really find it really fascinating. I don't have the math brain for, you know, really hardcore systematic trading, but I love the concepts and thinking about them in that way, and really getting to learn from people. I mean, that's the beauty of being a reporter or working for these firms is you get to ask questions of really smart people. I always say like I sometimes call it stupid like a fox. You almost want a little bit of ignorance at times because it forces you to ask questions and really understand things instead of sort of yeah, I think I get that, sure. I want to really ask questions. There's the risk that you sound like you don't know anything, but I'd much rather risk seeming like I didn't know anything as part of the process to learning something for real, you know, than sort of kind of faking it along the way. And you know, I think there's yeah, right. Yeah. Yeah, it's funny. I've worked on movies before, and they're kind of like startups that you shut down in 6 months. You know, and so you build this big operation, and then you're trying to bring some semblance of order to the chaos. But you know, the beauty of seeing a lot of different industries and places is you get to. Picasso had a line that bad artists borrow, good or imitate, and great artists steal. And I sort of think like that. If I see a model that works well in one industry, I want to steal it and translate it to another one, and try to think about that sort of cross pollination of these different things. maybe this could be the cold contact business development that I don't always excel at. Yes, please do. So the company is N2 Communications, letter N number two. So I'm just, like we've got our website there, just letter N number two, comms.com, n2comms.com, and then for my sort of reporting work on Substack. I think I'm at Joe Flood History. There's subscriber, you can free it, and there's free subscriptions, and there are paid subscriptions. You get more paid, but yeah, that's please don't hesitate to get out. You can find me on LinkedIn and all these different the standard places. But yeah, Joe Flood and N2 Communications. Would love to hear from anybody and everybody, and I have a particular love for systematic traders. It's a fascinating world. I always learn. Yeah, always happy to talk to those folks because it's always great to be able to help tell a story. Like how do you translate your technical trading expertise into an amazing story? Some storytelling expertise to help out. I hope so too. Thank you, Alexei. Real pleasure.